What factors, thank you. What factors go into a mortgage qualification? What does a mortgage lender look at in order to assess buyers' buying power? So they are income, credit, assets and liabilities, purchase price, and down payment. So let's look at them individually. So income. In order for income to be used by a mortgage lender, it has to be mortgage qualifying income, which is defined as income that is deemed sustainable for a full 3-year period or longer. Usually we think of income from the perspective of employment, but there are other sources of mortgage qualifying income, such as for an older person, retirement funds, annuities, alimony received. In terms of employment income, the factors that we look at are the employment history. So somebody who has just started a new form of employment is not going to be able to use that income for a minimum of 6 months. And on hourly employees, it's up to 2 years before you can use mortgage qualifying income. The salaried employees are probably the easiest to work with. In that case, we would need only W-2s and pay stubs. Self-employed borrowers, however, are the most difficult in a post-COVID environment because naturally there is concern about employment viability in a COVID environment. And so for self-employed borrowers, there is an increased level of scrutiny and the standards are higher. If you're familiar with tax code, then you've heard of a 1099, or maybe you've been self-employed, received 1099s. But you know, that is the document that indicates the income and triggers the tax for a self-employed individual. We would need to get tax returns from self-employed borrowers. We would also need to get a year-to-date profit and loss statement. Here we are, and last day of September, and there's, you know, anything could have happened in the last 9 months. So while they may have a tax return for 2020, we would require a year-to-date profit and loss statement to assess that the level of income has either remained the same, increased, or decreased. We would also need to support that with bank statements. By the way, anyone who has a question, just ask a question.
I have a question. Is it in a situation, is it true actually that you can ask for the credit report or something else or some other documents right before the closing, the client, or right before the approving? Like if they brought you, for example, documents from last month and maybe they lost a job or maybe, I don't know what happened. So how, right before the, how many like weeks or days has to be before you approve the client?
Well, I think I'll be addressing that question. First of all, thank you for the question. I think I'll be addressing that question from one angle in this presentation, but we're talking now about a particular set of facts, and there are an infinite number of combinations and permutations. So I wouldn't want to speak to anything specific. And again, my purpose is not to train you to be able to perform my job, but to give you a sense as to what the sensitivities are. But I believe that I'm going to answer at least part of your question in about 2 or 3 slides. Okay?
Okay, thank you. Sorry.
All right. So again, when we are looking at employment income, these are the standards that we would look at for salaried employees and for self-employed borrowers. Oh, I'm sorry. It's the next slide, Ala. All right. So we look at credit. So credit reports. So that we're very clear, and thank you for the lead in. A tri-merged credit report is required, it says in caps for a reason, in order to file a mortgage application. So I'll talk to what you were speaking about in two respects. First of all, let's define tri-merged. So there are 3 credit agencies. Most consumers are well aware of that because they are sensitive to their credit rating, their credit score. It comes up in a lot of our conversations. You should know, for the purpose of this particular meeting, that first of all, most people are under the conception that the the credit score that they're looking at, be it on Discover or all these websites that purport to give you credit information, they are referring to what I would call the retail analog credit score. So if you were to go to buy a car or open a credit card, that would be the analog that the lender might look at. But first point for this training is that we are looking at a mortgage analog credit score. We're using the same 3 credit bureaus, but we are using a unique analog that is specifically dedicated to mortgage qualification analysis. Second, to your question, Ala, in some respect, I would caution realtors, going back to the end of our last meeting, that all pre-approvals are not of the same quality. There's a very wide range, unfortunately, of quality of pre-approvals out there. And one of the weak spots in pre-approvals in the market is the use of a less than a tri-merged credit report for the purpose of qualifying the customer. I recently received an email solicitation indicating that it would be cheaper for us to do credit reports with 1 bureau than 3, and why go through the trouble and sign on with us? The answer is because I'm only getting 1 of 3 credit bureaus information. So anyone that is using a pre-approval that was suppositioned on 1 credit score is not only unusable when it comes to the finish line, which is what you were talking about, Ala, but is unreliable, grossly unreliable. You're talking about malpractice in the mortgage business, using 1 of 3 credit scores for mortgage qualification, which is just one of a number of reasons why pre-approvals need to be scrutinized, which is why we're having this conversation. So hopefully that answered part of your question, Ala. Credit scores determine which programs a borrower will qualify for and the pricing, which is the interest rate of the loan. So as I'm sure you would guess, the lower the credit score, down to 640 for qualifying conforming conventional loan through Fannie or Freddie, is going to be more expensive than the same loan with the same parameters for someone with a higher credit score. Credit scores are grouped in 20-point tranches for the purpose of mortgage program allocations. And there's different pricing at every credit score. Moving on, assets. When we look at assets, we look at banking assets, including checking, savings, stock market accounts, qualified retirement accounts, that's why the asterisk is there, and permissible gifts. All of these are assets. A borrower needs to have assets in order to buy a house, right? Because you have a down payment and you have transaction costs. So before we issue a pre-approval, we want to make sure that the potential buyer has access to qualifying assets in order to be able to qualify. Then we look at, through the credit report, liabilities. Only the credit report can provide that, Allah. So if somebody is reluctant to have their credit run for whatever reason, we can provide what's known as a hypothetical closing estimate. If your credit score is above a certain number, this is where it will fall. And we're happy to distribute clearly labeled hypothetical scenarios, but you can't transact on hypothetical. And when you're a business professional in the real estate game, you want to be dealing with customers that you have a near certainty that you'll have a successful outcome. One of the weaknesses of new agents coming into the business is that they have too much flexibility in regard to working with borrowers without properly qualifying them. That could be to your detriment. It could kill a deal. It could kill relationships. It could kill your contract as a sales agent. So it's better to learn over time that it is important to insist as a condition of working with your buyer that they are properly qualified and that you are satisfied that they have properly vetted going into working together. Now, one of the things that you should know is that liabilities are of different, come from different categories, including recurring credit card debt. The word recurring is important because an American Express card is not credit card debt because it's deemed payable on demand, whereas all the other credit cards are recurring credit card debt. Other liabilities include medical debt, student debt, car loans and leases, and other real estate owned. Now, one of the things that we can do with a borrower, and I'm asked this all the time, of why is it in the borrower's interest to work with the lender early in the process if they have a low credit score, is because we are in a position to tell the borrower what they might be able to do to quickly amend their score. That is not to say that we are credit repair specialists. That's not the case. But because we have access to the credit report and we know what the liabilities sit on the credit report, we can use software programs to determine how much a credit score would be adjusted by paying off certain debt in order to reduce overall liability. Which leads us to ratios. So all these calculations about income, credit, asset, and liabilities all lead to the calculations of key ratios, of which there are two: debt to income and loan to value. So debt to income is mortgage qualifying income less recurring monthly debt. So the most basic formula for, in a perfect world, for a conforming conventional Fannie Mae Freddie Mac loan, a borrower can use up to 45% of their gross monthly income for mortgage qualifying income, less any monthly debt. That's the most basic formula. But every program has its own formula. And what I was referring to in that last sentence was what is known as the front ratio. You see, debt to income is actually two ratios. You may have heard these terms, front ratio and back, or simply front and back. Front ratio is the primary housing expense. So that goes back to the statement I just made, which I'll repeat. In an ideal world, without any other considerations, a borrower can apply 45% of their gross income less their monthly recurring expenses to dedicate for a primary residence occupancy. We all know that primary residence occupancy is entailed to include, if it's a mortgage, primary principal and interest, real estate taxes, and insurance. So that number has to be less than 45% of the gross income that's calculated based on the provisions that we reviewed earlier in the presentation. The back ratio is a measure of total debt. That total debt includes all of the other debt that we were talking about, which it would include, which I thought I had here in the slides, so I'll just continue. So we, as mortgage lenders, qualify a prospective buyer based on the particulars of a given property, meaning the purchase price and the down payment. And then we take a look at the ratios, starting with the debt to income ratio, where we calculate their income, their assets for closing and transaction costs, their liabilities to subtract from their mortgage qualifying income, and then we calculate these ratios. If their ratios exceed the maximum requirement, the borrower doesn't qualify for that program. If any single parameter exceeds the maximum amount, the borrower does not qualify. So knowing in advance whether or not your buyer qualifies for a house based on the offer that they made is well advised. Loan to value. These ratios determine which programs a borrower will and will not qualify for. Again, I'm not here to teach you how to be a mortgage lender and which program to recommend, but there are certain programs that lend itself towards higher loan to value and certain programs that lend itself toward a lower loan to value. All right, we've made it. I believe this is the last slide. So, you know, where the rubber meets the road with the real estate agent and the mortgage lender is when you receive pre-approvals or you issue them, or you rather receive them from a mortgage lender to attach to an offer as a buyer's agent. So in either instance, that's where a pre-approval, that's where the rubber meets the road. And so when you see pre-approvals, there are two terms that you should really intimately understand, and that is a contingent versus a non-contingent pre-approval. A non-contingent pre-approval will explicitly state that it's non-contingent and that it's an approval that conditions that the borrower does not have to sell other real estate owned in order to qualify. I'll remind you again, going back one slide, that the back ratio is going to include total debt, not the primary housing expense. So let's say a buyer, prospective buyer, already owns a house and they intend to keep it. They're going to have recurring monthly debt on that house, even if they don't have a mortgage, which more often than not they do. They're definitely going to have real estate taxes and homeowners insurance. And those remain monthly expenses that the buyer will be responsible for when buying and occupying a new primary residence. Is that expense going to affect the front ratio or the back ratio? It's going to go to the back ratio. Thank you, Fiona. It's going to the back ratio because the additional real estate owned is an additional expense. It is not the primary housing expense. Okay? Now, one other thing I wanted to go back to, which is, I think, really kind of important, if I may, was the income. So we were talking about salaried employees and self-employed borrowers. So let's talk about combination and permutation. Do any of you know real estate agents that work a full-time job? Right? They work 9 to 5. They're a financial analyst. They're an accountant. They're whatever they are, and they get it. They get a what? A W-2, right? So they're a salaried employee, right? Everyone says yes. Yes. Okay. But in the capacity as a real estate agent, what are they? Self-employed. Okay. So if somebody is strictly a real estate agent, they're self-employed. What if somebody does both and wants to use the income from both their day job and their night job and their weekend job in order to qualify? That seems like a reasonable proposition. No, it is. The question is this: is that borrower a salaried employee or self-employed borrower? Both. Therefore, we view them as a self-employed borrower. Okay. So now, what does that mean? That means that suddenly this accountant who has a W-2, who I could qualify in about 30 seconds with current pay stubs to verify that they're working and that the income remains at the same level, now is going to hand me 1099 from their real estate work. And now I have to ask for business tax returns, for year-to-date profit and loss statements, for bank statements. So you can't be both for mortgage qualifying purposes. You are either salaried or self-employed. In the case, and it was a little trick question just to make sure somebody was still awake here, it is if you have both, you are deemed to be a self-employed borrower, and that makes it a more difficult qualifying proposition. All right, we were in the middle of the last slide. So we were talking about the difference between non-contingent and contingent approvals and what it means. When you're a sales agent, you need to not only view the quality of the pre-approval, I know I've said that repeatedly for good reason, but in addition to that, you need to determine whether or not you're looking at a contingent or non-contingent pre-approval. Because a contingent pre-approval means that you have somebody who's put in an offer that's relying on the sale of, more likely than not, their primary residence in order to qualify for the loan. That is not as strong an offer, all things being equal, as somebody giving the equivalent offer on a non-contingent basis. Okay? So I will leave you with these few words. When we say we're available nights, weekends, and holidays, we mean it. We're there to help answer your questions as they come up. You know, it's hard enough learning all of the technique and nuance that it takes to be a real estate agent. Do not bite off more than you can chew. Do not take risk where it's unwarranted. If you have a question about a pre-approval, tell your buyer that you want to get it clarification. Feel free to refer that buyer to a second lender for a second opinion. Insist on being confident as their agent that you're going to be able to transact with that buyer, because you don't want to be in the case where you're running around with a buyer, specking your time, and then you get into a deal, you get yourself all jazzed, it blows up at the finish line, you have a problem with the agent, the house has to go back on the market. It's the worst case scenario, and it's avoidable. There are only two reasons why deals blow up: inspection issues and financing issues. Inspection issues, I submit to you, are self-correcting. The foundation is back, the owner either is going to fix the foundation or is not. If they're not, they're taking the house off the market. If they are, they're going to fix it. It solves itself. A financing issue is not necessarily solvable. Get yourself into a situation where you have a buyer that just will not qualify. So that's the situation that we want to avoid. That's worst case. So that's why we would like to build relationships, mortgage lenders with real estate agents, so that we can become your trusted vendor of confidence, so that you can turn to us and say, this is the situation, as Ala did earlier in the conversation here. She's looking for guidance on a particular set of facts. That's what we're there for. I know I've said this before, but there are an infinite number of combinations and permutations. It's up to us to figure out what the dynamic is. And you can ring my phone at any time if you're looking for some help or advice. And I thank you for tuning in. Are there any questions? Because I kept talking. Okay, go ahead.
I'm a new agent, so maybe it's not the question.
No, we're here for new agents.
For example, is it would be smart enough to ask a client or a buyer, for example, in the beginning somehow, what is their credit score, or run some kind of screening? What do they usually do to make sure the buyer actually is qualified to purchase something before, like you said, it's all running around and everything starts?
Right. So there is no cost or obligation for a borrower to get a proper pre-qualification. If somebody suggests there is, you should run away as quickly as possible. There's no obligation intended there. And you are you're doing your buyer the best service that you can as a real estate agent to make sure that they're properly qualified. One of the things that you want to add to your repertoire is being able to explain to a buyer why in a competitive marketplace, it's essential that they have a rock solid pre-approval. If you can get them to understand that and get them to act accordingly, then you're well on your way to finding success in this business.
Most of them come with these pre-approvals already, but if they kind of waiting on results, is it a sign that either they're not doing it or they have something, maybe they think they're not going to be pre-approved? And I guess that's already a question to my coaches, what to do in that case, of course.
Right. So I think you're asking two questions at once.
Yes.
First of all, so I'll split it into two. So honestly, who's kidding who? You get off of the line here, and if you needed to issue a pre-approval to yourself, how long do you think it would take before you could get a pre-approval online?
Not
15
long.
minutes?
Yes.
10 minutes? Okay. So when you say the buyer comes to me with a pre-approval, that's exactly what I'm talking about. That's exactly what I'm cautioning you against. That's where you're running the stop sign if you don't say to the buyer, listen, all pre-approvals are not the same.
Yeah.
The fact that you got a pre-approval does not, convince me that you have been properly vetted and that you're getting the proper guidance. And the last thing that we want to happen is for you to create optimism on the part of a buyer that cannot be performed upon. So it's in the buyer's interest for you to say, no, stop. ABC pre-approval is just not going to cut it.
Okay, I see.
All right. Now, there was a second part to it. We're all in sales. So if you're getting the sense from your buyer that there is reluctance to pull credit, then your instinct is probably justified because
Mhm.
they have some concern. Why would it be in their best interest to let them run around in the marketplace, put in offers, jeopardize your reputation, the reputation of your branch, running around with somebody that's just not going to be able to get it done? Now, the advantage to engaging a lender is that, again, and this was part of what I had shared, is that once we are in substantive contact with the prospective buyer or borrower and we have the information, then we're in a position to tell the buyer what they might be able to do or want to do in order to increase their chances of finding success, whether it is modifying the offer, the terms of the offer, or working on their credit in order to raise their credit so that they can qualify. These are, knowledge is power.
Yes.
And unfortunately, the internet has weakened all of us because there is this mistaken notion that a piece of paper that says I'm pre-qualified is going to work. Might work.
Yeah. Hello?
Yes.
Yes, yes, yes. You're still there. I feel I lost you. I'm sorry.
Okay.
Okay.
Fiona
Okay.
had a question, but she was asking quietly. She's next up. Go ahead. Speak loud. Okay. So glad you asked. Fiona asked, and this is beyond our conversation today, but I welcome any questions anytime, and that's a great question. So her question was, why does it take so long between getting the lender the signed contract and getting the credit approval, getting the mortgage approved? She actually asked two questions as one inadvertently as well, because therein lies the distinction. So many mortgage lenders will market sharply and tell you that they'll get your deal done more quickly, super quick, 8 days. Oh, we got our deal done in 10 days. Here's what's going on behind every deal. And you already know this, but now you'll know it with clarity. Okay. First of all, there are components to mortgage approval. One of them is credit approval. That says that we vetted the borrower for their particulars based on everything that we discussed today, and this borrower is qualified for this loan. But that's not mortgage pre-approval. That's not mortgage approval. That's the first component of mortgage approval. The other two components of mortgage approval are title and appraisal. Credit approval can be done very quickly. This is what these lenders are running around saying, oh, I'll get you credit approval, but you can't get a deal done without an appraisal. You can't get a deal done without title. What's taking so long, Fiona, is title and appraisal. That's why it's taking so long. I'm so glad you asked, because the next time a mortgage lender says to you, oh, I can get it done in a week, great. You're going to get an appraisal back in a week. No. There you go. So is there anybody else that has a question? I'll take that as a no. I thank you for your time. Thanks for joining. And I hope to do this again soon. Bye-bye.
Thank you so much. Bye-bye.